Okay.
Welcome back to Mortgage Minute Live. You got a holiday view of Tracy and I being able to go and rock through this thing. Hey, Tracy, thanks for joining us as always.
Hi, good morning.
You can see the Thanksgiving edition where we're watching that. You got one watching the kids and the other one getting ready to do some work for Pi Day. So it's going to be a good time.
Yeah, busy day for sure.
So today we wanted to talk about, this is something that we've talked about before. It's been a little bit, but we've had a couple of borrowers that have popped out that weren't quite ready to be able to buy, but they needed a little help. So, they weren't necessarily, they wanted to know, can you have somebody co-sign but don't occupy the house? So what does that look like?
Yeah, so this is pretty popular. I actually just closed one for a friend a few days ago, and it works really well when you have someone who has good credit. It's just maybe more of a debt to income ratio issue more than anything. So this is pretty common with young adults who want to buy, but maybe they just haven't been on the job long enough, or maybe they have credit established and it's okay, but it's not extensive enough for them to qualify on their own. So ideally, I try to qualify people on their own without adding someone to the loan. But in a situation where they just need a little extra help on the application to qualify, then we talk about doing what's called a non-occupying co-borrower. So basically, that's when, let's say, mom or dad or a friend or a partner or a spouse are actually on the loan with the borrower, but they don't intend on occupying the property at all. They would be on the loan, and typically they're not on title. So they would help qualify, but they wouldn't have that ownership interest on the title. So the situation that I just closed last week was the borrower's credit was great. She had very little debt, but she owned multiple houses and she wanted to buy this new house as an investment. And she had multiple jobs. And whenever you have a multiple job situation, you want to have a consistent 2-year history. That's just a guideline that's required. And hers was somewhat self-employed, somewhat W-2. She had some changes over the past couple of years with each of these employers. So we weren't able to add and use all of the income that she was currently receiving. So at that point, I said, hey, look, here's another good option. And she had a great person with a great credit score, low debt to income ratio, and a great job history, who basically served as a non-occupying co-borrower, and she was able to get the property as a
That's
result.
cool.
Yeah.
So is this something that you find that most people do like on a temporary basis? Do they stay on it more permanent? What does that look like?
So it just varies. I mean, the only way to get the person off of the loan is to either pay off the mortgage via cash or refinance, or by selling the property, because they are in fact on the loan. So that's the only way to get them off. So if there were a refinance situation, i.e. rates drop, or you want to do a cash injection because you sold another property, or values have gone up and you want to eliminate PMI, various reasons for refinance, at that point we could reevaluate with just that occupying borrower to see if they qualify on their own.
So this, like you mentioned, this is a good one for young adults, and because prices have kind of been escalating a little bit, being able to get that first mortgage is a little tougher than what it used to be, with because wages haven't kept up with the way prices are
Inflation
going.
and everything else, right? Yeah. So if you have someone who, wants to buy a house and has the means to pay for it, but maybe from a debt to income standpoint, they don't qualify on paper, or mom and dad wanted to help anyway. This would be another great option. A few years ago, I helped a 19-year-old buy a house. Mom did a great job helping her establish credit. She had been working since she was old enough to work, so she had a job history, but she just didn't have enough to qualify on her own. So mom served as a non-occupying co-borrower, and she got the house. She, had a friend who moved in with her and rented the other portion of the house, the other room. So she basically had half of her mortgage paid by a friend who was renting the room, which is great.
That's super cool. So
Yeah.
we
Yeah.
love to see young borrowers get a head start on some of these things. I mean,
Right.
I think both of us got a pretty decent start, but
Yeah.
not 19.
Not 19. Yeah.
That's awesome.
Yeah. And you just have to watch how you structure these, because if you have someone who is on the loan with you who isn't going to occupy, you want to pay close attention to property taxes and how that affects homestead. If they're not on title, if the non-occupying borrower isn't on title, then obviously depending on the parish, the county, the state, then at that point the main borrower, the primary borrower, should get full homestead exemption on their property taxes. If for some reason the non-occupying borrower, co-borrower, wants to have ownership and be on title, then you would lose a portion of that homestead exemption on property taxes.
That makes sense. So, would that be, you mentioned that not that the non-occupying home borrower doesn't have to be on title. Is there an advantage for them to not be on title versus being on title?
I mean, that gets into some legal issues. If the primary borrower doesn't pay or they default, I'm not an attorney, so I would defer that out. I won't answer those questions, but mainly for me on the front end would be the homestead exemption on the property taxes.
Yeah, so save a little bit of money.
Yeah.
And then, of course, for those that are wondering about ownership interest and all that, make sure you consult your attorney. So
Right.
That's what we aren't.
Yeah, not an attorney. But the process is pretty easy, and I've been doing these more and more, where kids want to buy houses, but they just don't quite qualify from a debt to income standpoint. And what's great is, like, instead of mom or dad, buying it as an investment property or a second home where the terms aren't quite as favorable, i.e., the interest rate is higher, the down payment requirement is higher. If you do it as a primary borrower with a non-occupying co-borrower, then you get all of the benefits of a primary mortgage, meaning the lower rate, lower down payment options. Now, you can't do this with every product and program. For example, you can't necessarily do it with VA. You can't necessarily do it with RD, but this is a good opportunity for a conventional loan or an FHA loan.
That's super cool. So where could they find you if they got more questions?
Tracy.Lacer at HancockWhitney.com.
Awesome. Thanks so much for joining. We'll see you guys next week.